Hello, today is August 18, 2021, and thank you for joining me for another edition of the Market Commentator Podcast. It's very nice to be back with you today after my 2-week absence. Unfortunately, Jake could not join me, so I will be flying solo today, and we will be discussing the pros and cons of hedging market risk and a new approach that looks to have significant advantages over more traditional approaches to hedge the risk of a market sell-off. Before we get started, please keep in mind that this podcast is for informational purposes only, and that the views expressed in today's podcast are my personal views and not necessarily those of the Milwaukee Company. I'd also like to let you know that Jake and I are trying to figure out ways that we may improve our podcast. And to that end, we're working on a short survey to help us investigate what we could change and how to improve. We'll be emailing you a link to that survey in the near future. If you'd be so kind, please take a few moments to complete it. Jake and I would really appreciate it. All right, with that said, let's start. As surprising as it may seem to some of you, it certainly seems surprising to me, this S&P has now doubled from its pandemic low on March 23rd, 2020. And that marks the fastest the benchmark index has accomplished this feat since the end of World War II. This sudden and rapid increase has caused many clients to worry about the risk of a correction and what they can do to hedge against that risk. So I'd like to talk about that today, and I think perhaps the best place to begin is just to make sure everybody has a good understanding of what it means to hedge market risk. When we're talking about hedging, we're really just talking about a strategy that tries to limit risk in financial assets. So if we say that differently, a hedge is an investment that is intended to outperform when other investments in a portfolio underperform. An analogy I often use when I'm talking to clients about hedging is home insurance. The reason you get it is you want to limit your financial loss if your house burns down, but you understand that if your house doesn't burn down, the insurance premium you just paid for the coverage is essentially lost money. And in the world of investments, a hedge is an investment that's expected to offset the risk of another investment losing money, but that will probably underperform or lose that the hedge will lose value if the covered investment does well. The most common way to hedge, and the one that's the most traditional and one which I am a strong believer in, is simply diversification, where you invest in assets that are not well correlated. When we talk about correlation, of course, we're talking about assets that move in opposite directions. When one goes up, the other tends to go down. So, for example, instead of investing completely in stocks, you might invest 60% in stocks and 40% in bonds, even though history has demonstrated that over the very long term, stocks will outperform bonds. The problem is nobody is able to ride out the volatility. Not nobody, but most of us aren't able to ride out the volatility of a 100% stock portfolio. You can just imagine how that would have performed in the coronavirus bear market, or the bear market of 2008 financial crisis, or before that, the bear market associated with the tech bubble bursting. So hedging is a very straightforward way to, diversification is a very straightforward way to hedge against equity market risk. Another type of hedge is option contracts. And I can't really get into a full detailed discussion about option contracts here, but I've done that in the past if you want to check some of our prior writings and blogs. But the simplest example of an option being used to hedge market risk is when you buy a put option contract, and that contract sets a floor price at which you can sell the covered security until the option expires. So you can set a price that you can force someone else to buy your stock if the stock drops below that price. But if the stock stays above that price, then you lose what you paid for the hedge, for the put options. And that can get to be expensive, and really be a drag on returns. And that's really one of the issues with hedging. Let's talk a little bit about the pros and cons of hedging while we're at it. The biggest advantage, of course, is that hedging can reduce losses if the market goes against you or an investment does not turn out as you had hoped. right? Because the hedge is going to increase in value under those circumstances if the hedge is well designed. The drawback we've talked about is the cost of the hedge. Hedging is not free. And over time, hedges can prove to be very expensive and a major drag on return. In other words, when you get right down to it, the simple way of looking at hedging is it reduces potential risk, but it can also chip away at potential gains. And it's this potentially high cost of hedging that has had us work at the Milwaukee Company looking to ways to try and provide some of the protection of a hedge without necessarily the great costs that can come from a hedge over time. And that effort over the last year or so has led to the development of a new strategy that we're calling smart market beta, or I'm going to refer to it as SMB for short. By way of background, when I say market beta, that's just a term that's used to describe the return you would get if you invested passively in the entire stock market or the entire bond market. So market beta is the risk and return associated by the market in total over time. This terminology that is used in the financial world makes the terminology I used as a lawyer seem simplistic, but it is what it is, so we'll use it. And so SMB, this new strategy we've come up with, is designed to capture market returns under normal conditions and reduce drawdowns when economic or market conditions suggest that the risk of a stock and or bond market corrections are elevated. Let me elaborate on that a bit. In other words, at the Milwaukee Company, we believe that over the long haul, the market, what we sometimes refer to as Mr. Market is the smartest guy in the room. He's certainly smarter than me. I think he's smarter than virtually every other investor and portfolio manager. The problem is that Mr. Market can go all over the place and suffer major drawdowns. And human nature being what it is, when the market really tanks, it's very difficult to simply sit on our hands and do nothing, which means most investors aren't positioned to capture market beta in its purest form. They're going to try and time the market to some extent. And it's that market timing that can cause a lot of problems unless you do it very well. And in a very disciplined manner, I should probably say. And the same thing when the market is going up, when the market's really rallying, everybody tries to jump on that train and get on board and participate in the rally. And again, that is, creates a lot of it. You're not performing market beta in that time. You're trying to outperform the market, which is very problematic over the long term as well. So what SMB is designed to do is to capture market returns under normal conditions and to reduce drawdowns when economic or market conditions suggest that the risk of a stock or bond market corrections are elevated. In other words, we're not trying to outperform the market during good times. We're happy to go along with what the market will give when times are good, but we do want to try and lower risk when times are bad because we want to have the comfort of knowing that we're not going to lose a huge percentage of our portfolio, even for a period of time. So when market risk appears normal, the SMB strategy invests in a market beta portfolio consisting of passive broad market index tracking ETFs that in the aggregate are reflective of the entire stock and bond market. And thanks to Vanguard, that's pretty easy to do. For example, anyone listening to this podcast can easily capture market beta by simply investing in two funds, Vanguard's Total Stock Market Fund, which is VTI, and Vanguard's Total Bond Market Fund, which is BND. And allocating your investments amongst those two funds in percentages that would make you feel comfortable is a very good way to capture market beta. And for we've all heard, I think, of the 60-40 portfolio, 60% stocks, 40% bonds as kind of being the benchmark. And so if a person was simply content to capture market beta and ride out bear markets and and not go overboard during bull markets, then 60% allocation to VTI and 40% allocation to BND might work out quite well. And that's what SMB does when market conditions look normal. But if it appears that risks appear to be high, then the strategy will take a more conservative approach by lessening exposure to just those funds held by the strategy that are most vulnerable to the perceived risk at hand, and adding to strategy allocations that have provided relatively stable returns during market corrections. So to elaborate on that, what I'm talking about there is we don't simply invest in one fund, VTI or BND. We take VTI and break it up into the different sectors that make up the stock market. And same with the bond market. And the reason we do that is different sectors respond differently to bear markets. Some of them do relatively well, and some of them do relatively poorly. And it's only the poor ones, the ones that do the worst when you have a bear market, that S&B gets out of, and then it goes into the safer alternative investments. And the same thing with the bond market. The biggest risk to the bond market, of course, is rising interest rates. And so when it appears interest rates are rising, S&B doesn't get out of all bonds. It just simply gets out of what's called longer duration or more interest rate sensitive bonds, and rotates into bonds that are less risky when interest rates are going up. So you maintain the 60-40 type of allocation, but you're getting out of those funds that present the greatest risk to the portfolio. Now, the key to making this all work, of course, is coming up with a set of indicators that are effective at identifying when market risk is elevated. And we feel we've done a pretty good job of that. We've developed both an equity market risk indicator and a bond market risk indicator. The equity market risk indicator is determined using a 4-factor model of the S&P 500's price momentum and return volatility. And if anybody's interested in getting into the details of how that indicator works, send me a message and I'll send you the data and the technical aspects of how we structured that. But suffice it to say for this purpose that in our back test, this indicator issued a risk-off signal approximately 30% of the time for equities since 1997. So for 70% of the time, we're going to be riding along in the market beta portfolio. 30% of the time, we'll be going into what we'll call, let's say, a low-risk portfolio. And in that low-risk portfolio will consist of the market beta portfolio with some changes where we take away about 1/3 of the equity exposure that's the most vulnerable to a bear market. And the same thing on the bond side. But in that case, interest rate risk is profiled using a 2-factor model that estimates the probability of interest rates rising or falling in the near term. And in this case, the indicator is derived from the fair value model of the 10-year Treasury yield and the trending behavior of Treasury markets generally. In our backtest, this indicator indicated risk was elevated about 14% of the time since 1997. And so we've been really we've tested backwards and forwards and both back tests and simulations that are forward looking, and SMB, the strategy has stacked up very well as compared to both a passive portfolio and as compared to the other Milwaukee Company strategies. In the back test we've conducted for the SMB strategy, which used market data from as far back as 1997, the strategy was able to keep pace with a passively managed benchmark portfolio, which consisted of 60% of the total stock market and 40% of the total bond market. But it was able to do that with much smaller drawdowns. Specifically, while the benchmark suffered a maximum drawdown of 38%, the strategy, SMB's largest drawdown was only 16%. So it might be kind of hard to write out a 30-some percent, almost a 40% drawdown. But to ride out a 16% drawdown might be something that people are comfortable with. Certainly, I think most of us would be anyway. I think that's a pretty impressive result, especially when we consider the fact that during the back test, that back test period includes the tech bubble burst, the great financial depression, and this most recent COVID pandemic. In fact, the results were so strong that we've decided to make the SMB strategy a core component of our portfolios for Milwaukee Company clients. And if you're a Milwaukee Company client and you're listening to this podcast, I'll be talking to you about that personally in the very near future. But I do want to point out, of course, that because SMB is a new strategy, the hypothetical performance I just talked about being produced in our back test do not represent the performance of an actual account managed using SMB. So with that being said, I guess we can wrap up today's podcast. I want to thank you all for joining me. Please keep in mind that you should conduct your own independent research before acting on any information or opinions during this podcast, and that you should not act on anything you have heard in the podcast until you've discussed it with a qualified financial professional who is familiar with your personal situation and your investment objectives. And with that, I'll say thanks again for listening and have a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.